And again, this is, casual. We're not like, hey guys, we're live. I mean, we are live right now. Hi everybody. So we are live on the Military Retirement Blueprint YouTube channel, and that's, I know we're often talking about LinkedIn. We're obviously on LinkedIn. We're also on Twitter and Facebook as well. But essentially, this is our YouTube channel for us to share our concepts and ideas in that. Thanks, but in that sense, but consider it our channel per se. But Matt, we were just talking before we went live. A quick introduction to you, Matt Anderson, out in Colorado Springs, Air Force Academy grad, client of U.S. Vet Wealth. He's been extremely helpful in just explaining how he understood these decisions around military retirement and was looking at his money. And one of the aspects he mentioned was around health. Can you say what you were just saying again, Matt? And introduce yourself more if you want to fill in any gaps there.
Yeah, absolutely. Thanks, Scott. Matt Anderson, as Scott said, Air Force Academy graduate, retired 2 years ago from the Air Force as a colonel, and really started diving into a lot of these questions about, now that I've moved into the corporate sector, what opportunities and what is unique about military retirees, and a few of them that we'll talk financially. But the other thing that allows you to change your risk analysis, which is exactly what insurance companies do, is military retirees have the benefit of very inexpensive healthcare for the remainder of their life. So for me, I retired at the age of 46. My family is eligible for TRICARE, which, compared to our civilian counterparts, it's a very inexpensive way to get health care. And what that allows me to do with my plans is shift my actual age of retirement far to the left. So while many people may be financially able to retire, they continue to work simply to bridge the gap to the age of 65 when the federal health care kicks in that they've been paying into their whole life. So no matter what your financial goals are, it's good to realize what benefits you've earned through your military career. And for me, one of the major ones is the ability to shift that no kidding retirement date to the left, spend time with your kids, your grandkids, your hobbies, travel the world, all things you earned through that hard military career. So no, that's my thoughts. Thanks, Scott.
Yeah, absolutely. Because I mean, that's the point, to be able to use your money while you're still healthy to enjoy it. At some point, I mean, I just was taking my mother to cataract surgery yesterday, and just getting her in and making sure she understands what's going on. Like, it's coming for all of us. We get that. So we have a unique opportunity. I mean, you military retirees do. I'm not actually a military retiree. I've just been talking to hundreds and hundreds of retirees over the last 15 years and recognizing, since I was kind of on the outside, but very close to this, I just saw all these different scenarios happen. And I've seen crazy success stories. Everything from my classmate I spoke to last week. He's a financial independence, retire early, did it all to a T. Saved 50% of his income for all 20 years of his career, and now he can live off that as a lieutenant colonel, retired. He's gonna RV around the country for a couple of years. Like, how cool is that? But not many people were able to pull that off. So let's be honest. So if you can kind of play catch up, or if you don't even need to play catch up, but that's not your goal, you want to focus more on the continuing the wealth building approach. How do you do that? How do you settle into this higher income lifestyle? And that's really what we talk about with the war chest is, as Matt said, how do you move it to the left? Well, you do it by achieving not financial freedom. What does that even mean? You want income independence is the goal here, whether that's guaranteed streams of income, additional streams of income, more meaningful stream, whatever it is. But you're most likely, if you're talking to us, you're most likely going to be on a 250K plus, probably a lot more than that within a few years, annual income stream. So that changes things. And that's why we have Mike Siebold on the call, because Mike he's been with us at U.S. Vet Wealth for going on 10 years now, of course, but he also represents Ash Brokerage, the largest insurance brokerage in the country, and they do more private wealth management approaches, and that's for wealthy people, for high income earners. So we're gonna share a story today about another colonel. This is an Army colonel. This is someone we've worked with in the past, kind of a more common generic scenario or base scenario. But the main story here as we get started is, what's the problem? The problem is not the cost versus benefit of doing a survivor benefit plan decision. That's the easy decision, really, because we know what the cost is. It's 6.5%. The benefit is 55%. If we look at it as a benefit, you only get the benefit if the retiree passes away. So what's the probability of that even happening? This plan is there's only a benefit if there's a survivor benefit plan. So retiree has to pass away first. So these are the probabilities. That 1 month of a payment, meaning that the spouse survives the retiree by 1 month, 75% chance that happens, 74%. Not 100% that they get any money back whatsoever, only 55% that they get the actual return of cost. So say the retiree lives 30 years. Matt, looking young and healthy, I think you're going to make it. So only 57% chance that, assuming you passed away first, you'd even get your money back. But that's not even the right way to look at it. We should be looking at, we're life insurance people. We're trying to replace usually estate protection, protecting large income streams. That requires millions, hundreds of thousands, if not millions of dollars of death benefit. And that's what your SBP is actually worth, closer to, in this case, $1.4 million. So only 17% chance that money would come back. So that's what we kind of talk about and point out in the audit that we discuss. And just to think about what were we talking about there? Return on investment. That's just, if the occurrence happens, that's the definition of the benefit. Retiree has to die first. Return of premium is getting our money back, and return of value is that full value. So we're going to show that with our strategy, 100% chance that if you fund it properly, if you do it properly, and if you qualify, of course, you're going to get all this back. And then some. It's just, how it happens, and whether or not you pull the trigger on it is all up to you. And that's what makes this really cool. So here's the main thing, that when you're thinking about things like survivor benefit plan, it's not quite a benefit. It's more of a feature. It's not necessarily beneficial to everybody, right? So let's think about it in that context. So where are we on this map? We're making a decision on survivor benefit plans. So again, usually you're coming to us because you're like, all right, I don't feel comfortable with this. What are my other options? Or I do want to decline. What happens next? So that's what that looks like. We talk about those other things, and we'll do those in other weeks and other scenarios. But either way, we're always on a timeline here at Military Retirement. And when you're at your retirement briefing, they show you a slide like this and say, this is where you should start. And that's what they always tell you about everything. You should do this. You should do that. But that's not how it works. You've come into all this information and decisions whenever you come into them. And when you're asking your buddies, what did you do? We got to remember the context of when they were thinking about what was going on in their lives. So since I've done hundreds of these audits, I've seen all these different scenarios. So I can probably have a good idea of where you're at in the timeline, and based on that, which decisions you need to be making, prioritizing. Either way, we can make it easier, because instead of worrying about the stuff that everybody else is worried about, do I need more life insurance? How much is it going to cost? My health, qualify? We're just making this simple. We're creating a privatized backup plan, more income streams, place to put extra money, tax-free, by the way, when you're making more money, and essentially to maintain and enhance lifestyles if you want, whatever that definition is to you. Not necessarily about being rich. But even with inflation these days, we need the income to kind of, keep up with things. So we think you've got it. That's why the name of the book is Don't Forget Your War Chest, because so many retirees are kind of leaving this on the table because they're stuck over here on the left, worried about cost and benefits. It's like, you already got that. So that's where we start with the audit. I got other videos where you can look at that in more detail. So where are we at? We're kind of in the design phase today, and I'll let Mike introduce himself and what we're going to talk about here in a minute. But again, this is our scenario that we're talking about, what we did with the audit. Some things to think about. Obviously, the age is relevant from a health perspective, cost perspective. Michael explained how costs of insurance are always age and health related. But we can still manage the cost. That's the cool thing about this. We're in a software design here. Kids, knowing the ages of the kids is really important, because then maybe we don't need as much death benefit for 30 years like everybody wants to sell you. 30 years is valuable to the insurance company because it costs twice as much as 20-year insurance, but not much more probability that it's going to pay out. Thinking about regular military compensation, recognizing when you add up all your pay and benefits as an 06, you're already making close to that $250,000 income. Now, unfortunately, that's all going to be taxable now in the future. So we want to manage and mitigate future taxes. We can't necessarily reduce your current income now, but why pay future income if you don't have to? Income taxes. And then recognizing, hey, we're above average health. What does that mean? Not compared to your military medical records or your VA disability benefits or everybody else, to the average American population. That's who you're comparing yourself to. Well, especially if you're a pilot or a former, you guys are healthy. You might have 100% VA disability. And so let us help you understand that. Let us help the underwriters understand your medical records. So we've done this so many times. We know how to translate that in a way that can be beneficial for you. And of course, Michael explained, we can shop the market a little bit if one company's offering better than another.
Scott, can I jump in on there? Yeah, I wanted to, you said early on, if you qualify, and I think that's an important point here. It's similar to a high school athlete being recruited. Imagine what's going on in CU Boulder right now with Coach Prime. Coach Prime says, I ain't hard to find. And all these great recruits are coming to Coach Prime. And he's showing it on the field, what he can do for them in the future. This is no different. I think the military members that have retired and are now veterans are uniquely qualified to understand the concepts of risk and loss, because we've dealt with them our entire career. When I was a colonel, as a pilot, and I'm sending crews out on missions in combat, there are ways you mitigate risk. And there are certain crews and pilots that are going to lower the risk that's acceptable to us. And it's no different in our financial life right here. When you think about the chance of loss, which is the definition of risk, military members naturally are less risky than the general population in the eyes of those that insure. When they break it down into those three things, you talk about moral hazards. So the insurance companies are like, what type of person am I looking at? When you talk about alcoholism, smoking, drug addiction, willingness to defraud insurers, that is not typically the type of person that retires from a full career in the military. And when you talk about morale hazards, like, hey, I'm going to go recklessly drive on a Friday night because I'm insured. Again, this is not your retired senior enlisted, retired senior officer. And then finally, physical hazards, which what you just touched on, high cholesterol, all the things that, poor lifestyle choices, or just the bad luck of genetics. A lot of that has been naturally weeded out through the military service and the military medical. So I think that's another thing when we think about why veterans are perfect for this. Not everybody qualifies. Not everybody's going to get recruited by Coach Prime, but our veterans typically are going to fall into this category regardless of their VA disability.
No, absolutely. Absolutely. And actually, I'm going to go back through the transcript of this and make a slide about what you just explained there. Perfect. So what typically happens in as you're making these decisions, you're kind of on the traditional financial planning, like it's supposed to all happen in sequential order. But again, that's not how it actually happens. A financial plan should really look more something like this, where there's cash flows, ways to reinvest your money, but also thinking about, as you're at military retirement, what do I got with my audit? If we do want to reposition assets into the war chest for all the reasons that we'll talk about in a minute, then how would we do that? Does it come from existing income, from existing assets? Where would I use it later? Well, income independence is the general goal, but usually that also means whether it's increasing your job or retiring early. Sometimes people want to get into private equity, real estate investment, starting their own business, buying a business. I'm actually going to interview a guy here in a few weeks. Was buying a government contracting business, like with other people's money. He's getting loans and stuff like that. So really cool stuff that retirees don't quite know about yet. But if you learn about it and you don't have a way to financially feel comfortable of getting into it, then that doesn't help either. We're kind of an in-between from the traditional planning to the wealth management stuff. You don't have to get into that if you don't want to, but why not have your money in a liquid tax-free account that's protected, so you could, have more confidence to do those more advanced investments if you see fit. So that's another part of this, and that's kind of what my first book, Veteran Wealth Secrets, is about. But this is also not comparing, a TSP retirement account to insurance, because you don't compare your real estate investment to your retirement account. Different thing. Now, we can have similar outcomes, income streams. That's what we're trying to do with the account. But rather than owning a share in a stock or a mutual fund, or a stock in a company or a mutual fund or something like that, or an index fund where other people are managing the money, you're paying fees for whatever happens. With insurance, you're in a contract, right? So a contract, it's, there's the upside and the downside, but at least it's contractual. Like, it can go bad, but you see it right there in the contract where it can go. All we know with investments is it can go to zero technically, and they don't talk about that because they say, oh, that never happens. So either way, we don't have to worry about going down, because what we're doing inside the contract is it's not, just paperwork, because that's what you get the policy, but it's actually software. There's a lot of algorithms in here. It's looking at your health. It's looking at time frames, how much money you're putting in, how much death benefit you're buying. But there's inputs and outputs. How are you funding it over what time frame? What happens on the inside? We're getting cash value growth. We put money in and it grows tax-free. And when we want to use it, whether it's income or lump sum, you can access it tax-free. And then, oh yes, when you die, it's life insurance. There's a death benefit, but there's more to it than that. But those are the main features that we want to consider. And overall, inside the war chest, where does that fit in? Well, on the offensive side, as we talk about, and kind of the main aspects again: death benefit, uncapped tax-free growth, and that access to the account, the ability to use it for at any time for any reason is what's important. So, Mike, whoops, go back here. Yeah, Mike, that was the context. I just kind of wanted to bring people in, but I will send it over to you to run some illustrations and pick it up from there. So yeah, that was hot and heavy. That was quick, everybody. We're going to have longer webinars and videos that break down each of that in more detail, but we do want to always offer a little context before just diving into the numbers. So let us know in the comments, hit me up what your questions are, so we can do this better next time, right? So cool. Mike.
Yes. Hey.
That all good? Makes sense?
Yeah. No, that's cool. Great, man. Thank you so much. I appreciate it. And, thanks for everyone listening in and watching in on us here this morning. Appreciate everyone's attention to this. It's important stuff. So yeah, big picture, what Scott talked about is what's right for you and your family. And, we lean heavily into the private sector solutions. It doesn't mean it's right for everyone. We lean entirely into the education side of the table, meaning here's the public sector government option. Here's what's available in the private sector. What's best for you? And what we really want to do is educate and empower, so those decisions are made with the right frame and context. So that's really what we're here to talk about. The primary story for today is SBP, right? That's what everyone wants to know is, do I take it? Why do I take it? Why do I not take it? What's the story? I'll share quickly that 2023 was a change year provided by our government to say that if whatever decision you made at retirement, opting in, opting out, in 2023, they're giving you a do-over. They're saying, hey, if you opted in, we're giving you a chance to opt out. If you opted out, we're giving you a chance to get back into it. I don't know, Scott, we've had 60, 70 conversations this year on this. I don't think anyone said, I want to give the government more money. I think those conversations are, the one I'll highlight is I spoke with an 06 about a month ago, and he said, Mike, I retired 8 years ago. I've already put $45,000 into the SBP thing. Based on projections, I got to put another 200 and something into the deal. My wife's not well. My wife is, and I love my wife, but she's probably not going to be here in 20 years. So people like that. So being able to help those people say, let's not throw another $200,000 away. Let's build equity with those dollars. Let's give it access to those dollars. So just love doing that. Love helping the folks and educating on those options. So on the SBP, the first thing we talk about again is what I say direct qualifying cost. What does that mean? That means here is the tax, the SBP tax on your pension income. And I use that term intentionally because it reduces that income by 6.5% for some hopeful future value. What is the cost of that? And we're going to take that cost and buy life insurance. And so the message to the transitioning veteran and their spouse is you've got two paths here. If you are lucky enough to outlive your transitioning veteran spouse, you get half of 55% of their income paid to you over time. Or, conversely, if they pass away earlier on the life insurance side, we're just going to give you, the insurance company, give you, X amount of dollars, tax-free lump sum. Which one's more appealing to you and more impactful for your family? So again, the exact dollar, the SBP going into life insurance, we'll start with that. And that's kind of what I'd like to share. So let me go ahead and pull up my screen here. Let's see.
Oh, I see it now.
Can you guys see my screen there? Okay.
No, I see it. Sorry, it came on there you go.
Perfect. So again, this Nationwide Financial is one of many insurance companies we work with. We like Nationwide a lot for a couple of reasons. When I evaluate options, and just to touch on what Scott mentioned earlier, my firm, Ash Brokerage, represents every insurance company in the industry that's in the independent space, 70 plus companies, including Nationwide. And when I evaluate those options, from the 70 companies, probably 350 products, I look for low cost and I look for upside opportunities. And that's the Nationwide contract checks both of those boxes for us. And so the first one we'll look at here is a direct SBP replacement. So this individual, I've got his name kind of hidden, but this individual is transitioning out this year in a couple of months. And the cost of SBP for him is $531 a month. You can see that on the top of my screen. So I said, all right, instead of giving $530 or leaving $531 a month or just over $6,000 a year in the government's coffers, what if we put that to work for you? What if, in lieu of a hope and a guess, we just build guarantees around that? So we said we're going to take that $531 a month, which equates to $6,300 a year, and buy life insurance. And what does that do for us? So out of the gate, we've got $350,000 in life insurance that's protecting. So he passes away early. This is what goes to the family. As you'll see in the future, that number gets higher, closer to life expectancy. Because as we design this, we want to ensure that we want to keep the costs low, which is why the death benefit is lower initially. But as importantly, when we get close to life expectancy, call it mid 80s, late 80s, early 90s, we want more death benefit because that's what goes to the family at passing. So that was kind of accomplishes both worlds. So just going to look at the numbers here. I'm just going to page down to year 30 just for apples to apples. So we looked at putting this $531 a month into this policy for 30 years, which is the exact same amount of time he'd have to tax this SBP and the money would stay in the government. So that's $191,000 is the cost of the SBP. So in lieu of leaving that with the government, we're doing the life insurance strategy for him, and that equates to about $350,000 in cash value. So again, in lieu of leaving the $191,000 with the government, we're going to put it in our pocket. We're going to build equity on those dollars in addition to that death benefit protection. So again, $191,000 equates to $347,000 of net surrender value. So he could easily say, look, I'm going to take $350,000 and put it in my pocket and walk away. Always an option. And then you'll see, I mentioned earlier, the death benefit starts increasing down the road. And then again, as we go forward, there are no more dollars going into this policy. The surrender value, the cash, is increasing. And the death benefit, as I mentioned earlier, is increasing. Still the same 191 goes in. Now we've got 630 in cash surrender value and 660,000 in death benefit. And again, down here at life expectancy, we get close to $1 million in both buckets, again, putting 191,000 in the policy over time. So again, the story here is I want access to the cash while I'm alive. I want to protect my family when I pass away, and I'd rather not wait and hope and guess whether SBP pays off or not. As we see in the other slide, the math is not great on that. So that's kind of the idea on the quote unquote dollar for dollar SBP replacement. What I'll show you next is we talked to the same individual and we said, hey, what if we put that same $191,000 in this policy, but did it over 10 years instead of 30? What does that do for us? So the same amount of dollars just going in more quickly. We call this SBP Max. And essentially, this guy's got an income. His pension plus his VA is about 190. He took a job making 150. So for him to kind of hold back 20,000 a year is pretty easy based on his income and all those dollars coming in. And the nice thing about this, after 10 years, we're done. So after 10 years, there's no more premiums going in. So again, the same 190, but going in over 10 years instead of 30, what does that look like? So just as a comparison here, I'm going to go back up and show you where we were in this previous example. So we put 191 in, we got 347 in cash surrender value, liquidity, and about 365 in death benefit. Putting in the same amount of, actually a little bit less, right? So 190,000, the same year, double. The values are double. So that shows you the benefit of compounding. So what we talk about is flexibility. With this individual, we said, look, we'll get this thing going on the SBP, same, but start putting money in. And let's get the dollars going more quickly and fund it over 5, 10, 15 years, and then let the dollars grow for you and your family. And again, just looking down here at life expectancy, now we're closer to $2 million based on 190 going into the policy. So that's a very good example of what we do and looking at options to help our folks.
Awesome. Thanks, Mike. So that's, that's the base scenario. Right on. Matt, what are your initial kind of thoughts thinking, about the comparisons of the traditional SBP replacement, which is how folks are usually thinking about it, versus maybe max funding it?
Yeah, I think when someone thinks about the SBP, for me personally, I was like, that little amount, 55% of my military pension, if something were to happen to me, so in other words, a death benefit thought process only, that is not enough to handle. I retired at 46, not an unusual age for me. That is not going to help my family at all. They're going to need some sort of death benefit that's larger than that. And statistically, if only 2% of these traditional term life insurances actually pay out, and then they expire if you go 20 or 30 years with a term, this is a much better offense and defense. And I would say, using an NFL example, you're playing special teams as well. So any good football coach knows you got to play offense, defense, and special teams. And that's what this IUL offers. And, you see that surrender value, you see that death benefit, and we can talk about long-term care and all the different things you're about to go into. But for me personally, that was the no-brainer on this. And I just it's amazing how many folks are so busy at the end of their military career, they don't spend the time to listen to videos like this and say that government program, SBP, survivor benefit, you have to have a survivor to get the benefit. And you're not playing any offense. You're not having liquid tax-free income available to you. And for me personally, that's why I chose this.
You're not being rewarded for your health. I mean, that's ultimately, I think kind of the unfortunate thing. We get abused in the military. That's what we signed up for. It's like, hey, tell me where to go and what to do. And, that's what, but when you're getting out, the point of going through the VA disability briefing is to get the benefits back for that. But it's the wrong context if you're generally still very healthy, especially pilots. You have to get checked off a little bit extra. So, hey, Mike, if you got to run,
No, I'm good. I just had to have some guys working on the house. I had to make sure I took care of them.
I totally get it. I had to drive my mom. I went back and forth across the river here 4 times yesterday because my mom kept forgetting stuff for her surgery.
That's what we do for our parents, Scott.
It's crazy, man.
Why we
Absolutely.
need that long-term care this life insurance provides.
Yeah.
Well, I mean,
Mike, while you were gone, I was explaining some of the reasons why I personally chose to go with this option. But I wanted, as you were showing those illustrations, could you briefly talk about? I'm sure many of the questions are, hey, tell me what that means when I'm 90 years old, surrender value, and then the column next to it, the death benefit. Can you explain? Do you get both? Do you get one or the other? What happens after the initial 10 years? Do I need to keep the insurance portion going to get a death benefit? Can you just explain those two columns?
Yeah, no, that's a great idea. And Scott, I'm going to go ahead and share again so it makes it
Sure.
easier. If that's okay. All right, so let's see. Can you guys see my screen here?
yes, sir.
All right. So the question is, what are the values being? I appreciate you bringing that up. Allow me to talk about that, Matt. So there's two important values here: the accumulated value, the surrender value. You notice they're the same. So after the 10th policy year, these numbers are the same, and they're the same indefinitely. They would be different if we took cash out of this policy from a liquidity perspective, which we'll go through an income design, because a lot of folks use this as a supplemental retirement income, tax-free cash in their pocket every year. We'll look at that on a next call. But here's the values that are important. The surrender value is your liquidity. So while you're alive, you have access to about 90% of that tax-free, penalty-free for whatever we want to use it for. So you can take those dollars out. You can use it to buy a vacation home, spend a year in Europe. It's your money. You can use these dollars. And again, how does that differ from SBP? You don't have any of the money. You just got to hope that your spouse lives a long time. And if she doesn't, then you lose. And so with this deal, we've got cash we can use at our discretion. And obviously 90s, let me pull it back up here to a little more reasonable time frame. In our 70s, $500,000, we put 190 in. So that's the liquidity we can utilize. The death benefit is what's paid to our spouse at our death. So that is a lump sum tax-free death benefit paid to our spouse at death. That number is also, I touched on this, but that number is also the value that's utilized for long-term care. So one of the things we didn't touch on, I think it's a whole nother presentation for another day, but built into this solution is the option to utilize that death benefit while you're alive, tax-free, dollar for dollar, for long-term care. Now, Matt touched on the VA care solutions that are available through TRICARE and a lot of the options available to our veterans. We also know some things are uncovered in those areas. We also know in-home health, nursing care, generally not covered. Nursing homes, generally not covered. Let's protect against those risks as well. And the math is 2% of that number on a monthly basis. So 2% of $600,000, 12 grand a month. So about, slightly better than what the cost would be for in-home care today. So that's kind of what that represents. So again, while we're alive, surrender value is our liquid cash. And at passing, the death benefit's what goes to the family.
So just to clarify on that, let's say you're at the age of 70 or 75, and you want to take a little bit of this out, and you want to go buy a vacation home. You can take some money out of the surrender value, tax-free, go do what you want. Does anything affect the column on the right, the net death benefit, or does it remain the same no matter what you take out?
Yeah, no, great question. Great question. So the liquidity here is about 90%. And I say about, it's not exact. Every case is different, but roughly 90%. And I say roughly, it's between 88 and 92 of that surrender value is available from a liquidity perspective. So you can take a policy loan, and this is a cool part of the story. I'm glad you brought it up. These policies have a feature called a participating loan, and it's in this document a little bit further up. But what that means is I borrow my money out of the policy. Well, why would I borrow the money? It's my own money. Why would I just withdraw it? You can withdraw up to this basis, up to this 190 tax-free, anything over and above that. But a more efficient way to access the money is these loans. And the participating loan, what that means is the dollars we borrow out of the policy continue to get interest credits. They continue to grow based on the chosen indexes, which is up here on the top of the screen that we're looking at. based on these chosen indexes, those dollars continue to grow as if they never left the policy. And so again, on our next meeting, I'll go through what that looks like. But that's the answer to that question. The answer to the death benefit is if you start withdrawing cash, the death benefit will also meander down as well. It'll never fully go away. That's that 90% thing. But we're taking cash out reduces the death benefit. So what we see is flexibility. We see the option to use this from a liquidity perspective now or in the future. And then we make a determination what's most meaningful and needed for myself and my family in the future. And what I mean by that is some folks have plenty of cash. They don't need the liquidity. They have the death benefit. They want that to be as big as possible because they want to leave a legacy. Other folks, maybe they do need liquidity and they're okay with a smaller death benefit in the future, knowing that they can use the cash today while they're alive. And here's the thing. Our beneficiaries, our children, there's numerous studies on this. The 1,000 people they talk to almost invariably would rather mom and dad to use their dollars to support their lifestyle. And if there's anything left in the end, that's just fine. And I advise that to everybody. This is your money, not their money. So the answer to the question is there's two ways to look at it. You can have a lot of cash that you can utilize while you're alive and have a smaller death benefit to the family, which is okay. Or like, look, I've got plenty of liquidity. I know this dollars are here. I want to make sure that my family's got a nice big lump sum at my passing. The last thing to mention, and this is meaningful, you'll notice on here, looking at these this year right here, for example, you'll notice the surrender value, $701,000, death benefit, $736,000. Those numbers are really close to each other, really, really close. The spread there is what, 35 grand. Why does that mean anything? With life insurance, the cost, the internal policy expenses are based upon that spread, the delta between the cash value and the death benefit. As we get older, I design these policies so that spread gets skinnier and skinnier because as we get older, the cost of insurance gets higher. So if we can do that properly, we want the cost of insurance to be really, really low in the future. The last thing on that, this is a mutual insurance company. So in the future, beginning in the 15th policy year, they start rebating some of the policy expenses that were paid in earlier policy years. That's built into the contract. Again, as a mutual company, it's owned by the policyholders. And so why that's important is there are folks that will say life insurance is too expensive. And it certainly can be if it's not designed properly and funded properly. But the way we design these policies, we focus very closely on the internal policy expenses. And we get these policies running very efficiently from an expense perspective, somewhere around 1% or 1.5% over the long term, about the same as an average mutual fund. So again, that's the reason the spread here, the difference between that 701, that 736, that $35,000, that's the risk and that's the cost. And I'll show you really quickly, and I keep saying the last thing, this is kind of interesting. So this is that same year, age 79 or age 75 we were looking at. So here are the policy expenses. There's $120 of annual expenses. The cost of insurance is only $300 for a 75-year-old for $500,000 because, again, that spread is skinny. And then I mentioned about the rebating. This conditional credit column, that's a positive adjustment to the contract. So again, in the future, when everyone says it gets expensive, you'll notice this positive adjustment, this credit is actually bigger than all the charges. So most of the charges are born in the first 10 years. And then in the future, the credit is actually greater than all the charges. That credit's not, well, you're in $30,000, $40,000, $35,000 in interest. That's just the bonus credit on top of it. So again, we design these policies so they're successful for the long term by keeping the charges low. So that's a little bit of inside baseball, but I think it's important.
Mike, that inside baseball is huge. And one of the reasons, before I retired, I got that medical examination done. And I look at it, what you just described is I locked it in. Imagine at the age of, you talk to your parents, at the age of 75, would you like another life insurance policy for $300 a year starting at the age of 75? Everybody would say yes. It's a no-brainer. That is so cheap to cover you till the age of 90 or however you choose. It's just a no-brainer when I looked at it. And you're not going in at the age of 75 and getting your blood drawn and you're doing all these different things. You already did it when you're 46.
That's exactly it, Matt. Exactly.
And yeah, that's actually a good point. And Mike, if you got to jump, Matt, if you got to jump, let me know. We're coming up on 1 p.m. Otherwise, I got other slides. I can continue the conversation to kind of go back and review this. I actually already updated this slide. I was like, oh, we need to explain. Yeah, the input part of the inputs, the premium essentially is that's why it's not called just an investment. It's a premium because there's cost. It's a different function. It's kind of like a mortgage payment. A lot of things happen inside of it. But then that rebate is another outflow. And then I actually changed the outputs here because there's a more likely chance we're going to pull out way more tax-free income than any death benefit we'd leave. Unless, of course, we keep the option, and this is what we do through convertible term. This is our contingency option. We get a lot of death benefit early when you need it, but we have the option to keep it. And as Matt said, already approved. Like, we've got time, and we manage a lot of costs through this because maybe you don't need the term for 20, 30 years. Maybe you only need 10, and we can convert it within those 10 years. You're going to have the income for it. So that'll be the strategy, but don't need to do it all in day one where you got to throw a ton of money into it if you don't have the job lined up. So that's where we're.
Yeah, let me talk on that convertible term, just so everyone understands what that means, right? So almost invariably, what we want to do is protect the family. Out of the gate, mid-40s, early 50s, I'm retiring. God forbid I get hit by a bus tomorrow. I've got this pension that's an important asset. We buy insurance to protect against the asset, just like we buy fire insurance to protect against the house burning down. And term insurance is cheap, $1 million, a few $100 a year, maybe $1,000 a year. Why we like it is it provides short-term protection that hit by a bus. As importantly, that conversion, that convertible term, what does that mean? That means, just as Matt said, we get underwritten, we get approved based on our health today, and that buys us flexibility. It buys us future options to make the permanent policy protection bigger in the future. And why would I want to make the protection bigger, the death benefit larger? 2 reasons. Number one, the bigger the death benefit, the more money I can put in. And we've seen it invariably. We get this thing going at an SBP replacement premium of, in this case, $531 a month. We get a year or two into the deal, and then they're like, gosh, this thing's doing great. It's doing better than the way I assumed. It's, one of the things we didn't talk about is the performance of these things, 8 to 10% a year. It's doing great for me. I want to get more money. I want to put 50 grand in this policy for the next 3 or 4 years. How can I do that? Well, that term policy, we move over, we convert the death benefit to the IUL, to the permanent policy. Now we have a larger policy permanently. And again, 2 things that does: more permanent protection for my family that doesn't expire with the term, and more flexibility to put more money in. We just saw the benefits of putting $500 a month versus 19 grand over 10 years. So paying it over 10 years versus 30, compounding, time value of money, far more efficient. But we also know people, these are important decisions. These are important financial decisions. So we love the flexibility that those decisions don't have to be made today. What we made today is, let's get you approved. Let's get this thing in place. Let's protect the family. And then every year we evaluate options to fund it. But all being equal, the more dollars we get in the policy early on, the better the long-term outcome, as we saw in those illustrations.
Awesome. Well, thanks, Matt. That's all you got to run. We can, Bobby asked some questions. I'll just read them real quick and we can address them. This would be good topics for kind of future episodes. What's a conditional credit, based off of, and with regards to convertible term, what are the time frames that can happen? So we probably actually pull up a term illustration, kind of show some of that stuff next.
Yeah, we absolutely can do that. Those are good points. Yeah.
Cool.
I'll just touch on the conditional credit thing while we're on the subject. So as I mentioned earlier, Nationwide and several of our companies, Security and Nationwide, we've got a bunch of them that are mutual insurance companies. And it's kind of important to understand what that means. What's a mutual company? A mutual company means the company really owned by policyholders. If you're a policyholder in Nationwide like I am, you own shares in that company. The other type of, like Prudential, is a stock company. It's owned by stockholders, owned by trade on Wall Street. Not good or bad, just different. The mutual companies generally rebate some of the fees they pay earlier into the policy over time. It's kind of a thank you for being a policy owner. Thank you for being a shareholder in our company. Very common. It's not just nationwide. They kind of all do it. The parameters around that, first of all, after the 15th year, it's automatic. It's contractual. It's built in. What drives the amount of that credit is how the policy is funded. So a more richly funded policy, like that 19,000 policy we saw, the credits are bigger than a lighter funded policy. So it's contractual after the 15th year, and the size of it's based on the how the policy is designed.
Awesome. Actually, I just realized I should put up a different example for the insurance policy. Is Prudential not? I found this old.
Yeah, good point. Well, here's the thing. Prudential is the largest life insurance company in the country. Okay,
but they're not mutual
policies in anybody, huh?
But they're not mutual.
They're not a mutual company.
Okay, it's a bad example. Either way, you get the idea. Contract.
We do a lot of work with Prudential.
Well, sure. It's so in that case, Prudential wouldn't offer rebates then.
They have a different structure. Yeah, that's correct.
Okay, so either way, just knowing that each company works differently. One of the benefits of working with a particular company may or may not be these rebates, among other riders and things. That's the kind of thing with an insurance company. Again, it's contractual with add-ons. You can add on to the software or not. Sometimes there's a cost, sometimes there's not. Sometimes it's needed, sometimes it's not.
That's exactly it.
But cool. Well, I was just going to point out some of the other things we got going on. Hey, what this is, again, is all about is what the military retiree community, when it comes to the pay and benefits, we've come from years and decades of financial readiness, which means the priority is the readiness of the entire unit for deployments, and not necessarily your wealth and happiness in post-military life. And so that's what I've just seen, again, talking to hundreds of retirees over the years, recognizing that you're going to be making more income, and until that starts hitting your bank account, that's what Mike Wallace tells me when he's working with people through the career progressions at Blue Water Advisors. He's helping them get jobs at Google, Amazon, Boeing, and he's telling them to negotiate higher salary because they're just not thinking, how much they're worth. And then it really doesn't hit till it's like 3 or 4 months after they started their job, and like, holy cow, my bank account's been adding up. And so that's kind of the point. You're part of the 1% of the 1% that's going to be doing well financially or planning to. So should you leave that money on the table? No, you should go from deployments to dollars. I think you can do more with those dollars than just kicking it back up to Uncle Sam. Glad it's there. It is a benefit that it's beneficial when it's needed, whether it's survivor benefit plan or VGLI or whatever. But if you don't need it, why leave that on the table? So don't forget your war chest is kind of the motto here. So we do this, because we know how to address this and make these decisions, with you, or help you make these decisions, or just give you the context that you might need in a conversation back at the kitchen table. So we'll give you, whatever insights, just going to help you give your perspective. You can always make your own decisions. We're not, trying to get everybody to do this war chest strategy. It really only works for those like Matt who see the value, have the assets, have the health, and the motivation to do it. But if that's you, we want to help you get access to it, because you can't necessarily do this on your own. So whether it's doing the analysis of how to make the SBP decision, and these are all the government websites, or it's actually don't have that slide up, but going through the financial landscape of financial professionals, people like us, we're, rather than being advisors, we consider ourselves consultants or coaches if you need a little more motivation, but bring your advisors in. We'll consult and coach with them as needed. That's where we can fit in. We have just expert knowledge and access to help you avoid this. So this is kind of, our education platform, our office space, so to speak, is the Military Retirement Blueprint YouTube channel and platform. If you want to log into our platform and talk to us inside and see all our videos, download the book, and we're going to be loading more stuff in there. We got Blue Water. We're going to have a networking group. We're going to call it high caliber networking, because you don't want to just show up on LinkedIn like everybody else, right? You're part of the 1%. You don't need to network. You can find old boys networks, or actually Blue Water's kind of created that. So, and there's lots more in the networking sphere that we want to introduce you to. Like, I'm part of 10X Vets, came out of Service Academy Business Mastermind. I'm going to be on their podcast here in a couple of weeks. I'm really looking forward to talking to Scott Mackus about that. But those are the guys, they talk about private equity and doing deals. And it's like, okay, well, that world exists, but there's no in between. There's no hop, skip, and a jump over to either you know about it and you've already built up a bunch of wealth and you're just kind of doing it on the side before you get out of the military, or you get into it afterwards. But that's usually the guys that have gotten out at age 30 or something, right? They've stumbled into that, had the time. And so I'm saying, hey, you can still do that in the next 10 years if you want, because of the amount of income you're going to be bringing in. But not if you just lock it up in a 401k and can't access it, or your mindset's only going to allow you to use it for one particular purpose. So we put this together, workshop speaking. That's kind of what we're doing right now in the live training, obviously in the War Chest Academy. And then Trevor's got, I don't want to call it 101 because it's way more in depth than that. It's one of the best, just broad scope financial programs I've ever seen. I mean, I'm not joking, just because he was building it out and I took a look at it and I was like, holy cow, dude. Yeah. This is just extremely valuable. And that's going to tie into the asset mapping. And everybody who's done an asset map has gone, oh my God, I can see everything I'm doing financially on one sheet. Like, that's cool. My spouse was like, I finally get it now, so that's just a cool offer that he's going to be rolling out. But hit up Trevor if you do want to talk to him about that. He's rolling out a beta cohort and looking for people to that. And yes, asset map will be paid, but I think we're looking to do some, in-depth free analysis right now, same as what we're doing with the audits. We're going to have web pages up to link in or to sign up for all that, but you can hit us up in the meantime or email me, Scott@USVetWealth, if you want to learn more. But what this is really all about is laying out our whole program, because essentially, this is what we're going to teach. As Mike, you were saying earlier, this is what we teach the financial professionals. I mean, Mike's day job is a consultant for people like me, and so that's what we want to bring to the retiree. Like, why wouldn't you want to know this stuff anyways? It's going to be useful, especially if you're starting to build wealth. So, not trying to turn everybody into a life insurance agent, of course not. But it's not that complicated, but it's a new context in thinking of how do I use money in the future, rather than being risky and invest in the stock market. We can take those risks off the table. It's insurance. That's the whole point of it. So it's safe income theory is what we describe. So we'll get into all that in more videos, and then use these kind of longer case study scenarios to kind of do a broad brush. And if anybody wants to do kind of a hot seat, let us know and we can jump on that. But yeah, hit us up and we'll get that audit scheduled.
Let me just jump in there to wrap that up. So the audit story, I love sharing that. And what we like to do there, and in my world, we audit other folks' life insurance policies all the time. And I talk to a financial advisor, they've got a client, $2 million in assets, and they've got this life insurance policy. And my message is, I hope that policy is perfect. I hope it's priced competitively and has every benefit your client needs, but maybe not. But maybe we can be either more efficient, have additional benefits, hopefully save you money, or all three of those. And so going through that audit is just basically saying, this is what I got. What do you think? And we love coming back and saying, what you got is great. We also love coming back and saying, what you got is great. Here's how we can enhance it. So it's just, call it free financial advice if you want, but I lean into, as I've said before, the education of what we're doing here. I'm passionate about how we can help families with what we do. And that's why we get up and do it every day. So that, sign up for your audit, and I'd love to chat with you. Yeah.
Because we know, our thing's not going to be for everybody, but we know everybody's got to make these decisions. So that's our goodwill. Some of you are going to be a good fit. We'll point it out. If it's now or if it's a year or two for now, that's fine. That's our business model. We just know that it's just going to be easier for you to go home and make these decisions so you can move on to finding that next job. And, maybe if you got a health issue,
retirement with your family. I mean, let's take the financial concerns and risk, and let's replace that with certainty and guarantees. So that's what we love to do.
All right. Well, cool. Well, I appreciate everybody that joined us. Oh, the one thing I was going to do before Matt and Bobby dropped off is I was going to say, hey, if you are watching these videos, I want to, coach a little bit on, hey, how do we share in comment on the LinkedIn's and the Facebooks and YouTubes or whatever. And the way this works is the more watch minutes that a video gets, especially live, and then immediately after or whatever, the better chance that the algorithm or whatever on LinkedIn is going to find similar like profiles. So if you're a military retiree watching this right now, hit the likes, leave a comment, ask us a question. One, we'd love to answer your question, and that gives us, something to talk about as well. But, it also helps LinkedIn say, oh, okay, somebody finds this useful. I can, based on, they know about everything about us. Sorry, they can go find somebody else similar. So it's networking, right? So, and that's one of the things we're going to teach in our high caliber networking is how can you use similar strategies to find those whom you're meant to serve, right? We're not trying to do advertisements to get this out in front of everybody. We want to leverage the system so that people who would be more likely to enjoy this content, it would show up for them. If they don't enjoy it, then they don't watch it. Then the algorithm knows. Okay, I won't send it to those type of people. So so I say all that to say we really appreciate you watching this. We're staying niche and small. We're not going for numbers. We're trying to find the right people for this information, and either way, you're going to learn something probably about your military retirement decisions to make things a little bit easier and stressful, and give you some perspective to think about over the coming months. And if you've already been retired for years, why not go and make sure that you've got to know about everything that you got going for you and what the values are. Or if you're a few years out from retirement, don't do what so many people saying, oh, well, I'll get to that whenever I hit myself on that timeline. Why wait for the government's timeline about how you're supposed to retire? Yeah. It's your money.
You can do it. Healthier the younger you are.
That's why the motto is it's time to stop following orders when it comes to your money. Like for everything else, but once the dollar is paid to you from your LES, it's yours. So you can be more beneficial when you privatize. And that's what we're here to do. All right, dude. Cool. Great session. And my battery's about to die anyways. So I will say goodbye and we'll see everybody next week.
Thanks, Scott.